Excellent. Good evening, everyone. Good morning if you're joining us from the morning side of the world. My name is Charles Dossi. I'm the CEO of the DYDX Foundation, and I'm excited to host you for our first monthly analyst call of year 2026. We are joined today by a guest from Wintermute, Jasper, which will give us a little bit his views on the market and everything they're doing on the research side. But before that, we're going to jump on a quick update on DYDX, the ecosystem, and what we've been working on so far, and how 2025 essentially closed in a very positive way, and also how we can think about 2026 and moving forward. So I welcome you with some context about the market. We'll look at the market backdrop. We'll double click on some of the key takeaways of the annual 2025 DYDX ecosystem report. We'll look at protocol overview, some of the key metrics, buybacks. I know it's something which is important for many of you. We look as well as the progress made on the buyback side and how we can expect this metric evolving over the coming months. We'll talk later on to Jasper. Thanks again for joining us today, Jasper. Jasper is with Wintermute research team, and I look forward to his presentation. And as well, I prepared some rapid fire questions for him. And we looked also and double click on some recent strategic initiatives at DYDX. So let's get started. So as you know, as a macro context globally is very uncertain, even though we got some rates coming down, there is a lot of geopolitics moving every week, and it just creates essentially a neutral market today. So it has been modestly on the downside pressure and consolidating, but we're not in a free fall in any sense. But the sentiment is sitting a little bit between those two bands of neutral and bearish and bullish. And the macro driver are definitely, I would say, leading the market sentiment today. So that's something we are all working with. Should you be centralized, decentralized, spots or perps? That's something out of the control of all of us. But the good news is that the market keep expanding. The attention is definitely still here. The activity on the liquidity side is still, I would probably say, on the sideline, looking at things, getting ready for some spikes, but we're still in the neutral side of the market. On the next slide, we will touch on the annual report of the DYDX. So many of you might have seen that. I really invite everyone to download this ecosystem report. We did a fantastic work at basically consolidating the inputs from many different teams around the DYDX ecosystem to really look at what happened in 2025. Should it be the first or second semester? And looking at the growth milestone, looking at the different community-driven growth initiatives, but as well as the ecosystem and the governance. So if you want to download this, if you want to mash it up with your favorite AI engine, go to ecosystem.report/DYDX and you get everything there. And we'll bring you some highlights here. So on the next slide, we look at the protocol overview. Historically, since the inception of DYDX has reached $1.6 trillion of trading volume. So it brings together the version 3, the version 4, as the different generations of DYDX. Overall, the protocol fees have reached 64 million within DYDX V4. This is where the protocol fees were actually started to be generated on the DYDX chain. And the staking rewards has also reached $48 million. So these numbers really show you how the mechanics and the initial design of DYDX keep working and delivering, and essentially really putting the protocol in the hands of the community, in the hands of the stakers, in the hands of the governance participants. 386 markets are or have been available. There is a dynamic around the markets, some kind of hygiene, where markets which are not in demand anymore or maybe getting too thin in terms of liquidity might be removed from the order book. And the good news is that the community of DYDX token holders keep growing. We've reached 98,000 DYDX holders. I'm very confident within Q1 this year we will reach this milestone of 100K. So keep spreading the good words and keep staking DYDX and considering the DYDX token. It's a very fast growing community. The buybacks program, which has been implemented via governance with the community and the token holders, has been progressing, even though it's very much linked to the fees generated by the protocol as well as the volume of trading from users of the protocol. It has been capable to basically bring and buy back 8.5 million DYDX tokens from the market, secondary market, and essentially staking them to grow the security of the protocol, but also accumulate some staking fees in USDC to either finance strategic initiatives or buy back more tokens. In terms of trading volume, 2025 has been a rocky year for our industry overall, should you be a centralized or decentralized exchange. Q1 and Q2 have been going more on the market-wide deleveraging kind of things, reducing speculative activity overall. But what has been very encouraging is on the second semester, Q3 has seen a growth again in terms of trading activity on DYDX and a record Q4 reaching $34 billion of trading volumes. So this strong end of the year at DYDX, even though the market was not in the best setup globally, really shows that DYDX keep refining the products, the liquidity, the incentives, all different kind of parameters, and doing this in a very diligent manner. And this brings some more activity. So something we are very happy to start the year with is some results in terms of trading volume within DYDX towards the end of the year, despite a difficult market. In terms of protocol fees, this has been also kind of reflecting the level of activity of the protocol. Obviously, the more trading activity, the more fees are being generated. So overall, we've seen a growth over the different quarters of 2025. And if we look at the accumulated protocol fees since V4, $64 million US dollars was mentioned earlier, and this year only $16 million US dollar of trading fees collected by the protocol. So this fee trajectory essentially reflects an improving execution quality. I think this really shows that when the product is refined, when the performance and the capabilities of a protocol keep evolving and improving, the market essentially kind of comes in a more stronger way into this infrastructure. You've seen over the past months and quarters as well numerous efforts in terms of distribution for DYDX. You know that DYDX is available via the crypto.com wallet, via some other wallets such as Tor Wallet, but there was also some strategic partnership built around DYDX over 2025, such as Conroot or CCXT and some others, which essentially bring more some type of institutional or systematic trading type of trading volumes on the platform. So all of these distribution efforts, as well as more selective incentive, has been helping to improve the fees accumulation for the protocol, despite again a market which has been complicated. Number of active traders is also a metric which is important to measure, obviously. This number is overall on the growth as well, despite the complicated market we mentioned earlier. And we've been able to close as a protocol Q4 with more than 12,000 active traders on the protocol, which is the highest part of the year. So it's also showing that all this refinement in terms of incentive, in terms of quality of distribution, in terms of refining the incentive as well program. You remember that late in 2025, free trading been implemented for some specific trading pairs. All of this essentially has been helping to bring and keep growing the number of active traders, and that's a positive news and also a strong asset for DYDX entering 2026. The volume in December 2025 has been also choppy. Overall, $11 billion plus of trading volume in December 2025, one of the strongest months of Q4. Even though the industry was more into the soft side of the trading volume, DYDX has been able to keep experimenting and refining together with the support of the governance, the incentive programs, the different product features, the performance of the protocol overall, and this resonates well with traders globally. So this has been reflected into a strong December 2025 trading volumes metrics. Coming to the DYDX token, the current supply of DYDX token is about 822 million plus. Total market cap 160 plus million. The average price over 2025 has been at 0.61 cents. Obviously, the alt season is not coming yet. We've been all impacted by October 10 events as an altcoins industry, and it's encouraging to see that the protocol metrics are improving. It's encouraging that DYDX as a protocol has also some strong fundamentals, as numbers which are growing, as profitability as a target. So this should at some point resonate with the market, we believe, and help us to come back to some more usual levels of DYDX token. So DYDX token, as a reminder, is a utility token as well as a governance token. You can improve the security of the DYDX protocol by staking your DYDX tokens via validators, but you can also participate into the governance. Hundreds of votes happening every year. And we're going to touch on this a little bit later on. Overall, the vast majority of the unlock of the DYDX token are behind us. There's a buyback program which has been implemented last year, is just in motion and essentially hoping for additional volume and trading fees at protocol level to basically buying more tokens and improving the financials of the protocol itself. The DYDX token, as we mentioned earlier, close to 100K token holders. The growth is more or less 85% year on year, which is a strong signal that the mind share of DYDX keeps growing, and about 200 million, 237 million DYDX token are staked today to ensure the security of the protocol. The average APR over 2025 from staking rewards was about 3% plus. The buyback, we touch on this. If you want to follow the buyback by the minute or by the day, you can go to buyback.dydx.trade. This is where all the metrics are totally transparently shared with you. This program was launched in April 2025 via the Treasury SubDAO and the support of the community and via governance votes. And overall, this program has been expanding, reaching today 75% of the net protocol fees, essentially redirected to the buyback program to buy back DYDX on the secondary markets and grow the treasury of the protocol overall. All those tokens, for the vast majority of those tokens, are staked after being bought back to keep increasing the security of the protocol itself. It's a time for us to welcome Jasper. Jasper, thank you so much for joining us. You're connecting from London as you're with Wintermute. I look forward to the conversation, but I let you share with us first a little bit an overview and some of the quality of your work you're doing at Wintermute Research.
Awesome, thank you. And first of all, Charles, thank you for having me on the monthly call. So as mentioned, I'm one of the desk strategists, so I do a lot of research, and I'm one of the OTC traders as well here at Wintermute. And I'll spend a few minutes sharing how we're thinking about the perp market going into 2026. I think a great starting point here is by acknowledging what perps have become. So if we look at the total crypto market being traded, we see that 75% of that trading volume is happening in derivatives today. And a large portion of that is happening in perp futures. It feels like, especially 2025, there's been a large inflection both in volumes, but also in terms of the underlyings where perps are being utilized. Initially, mainly being deployed in, I would say, majors and blue chips, but now increasingly being deployed in that long tail of altcoins as well, as retail especially becomes more comfortable with using perps for leverage or any type of trading activity. If we look on this slide, so the big question is, why did perps win? Why weren't it options? Why weren't it long-dated futures? Why are we trading forwards? I think the answer is threefold. First of all, anyone who's used perps, I think, is very straightforward that its simplicity makes it a very elegant solution. So they eliminate a lot of complexity, and that usually makes traditional derivatives very hard. There's no expiration management. There's no rolling costs. There's no calendar spread. The only thing you need to look at is the funding rate. And on top of that, it is something new, but we feel that funding itself is also becoming an interesting yield instrument. There's a few very early stage protocols exploring this, but I think it's possible down the road we will see delta neutral players capturing funding rates more systematically in the same way that we see this today, for example, with CME basis spreads, depending on where leverage and positioning swings, people are capturing funding rates and in a delta neutral way. So that is very interesting that it's like a derivative of the fact that perps have become so large. I think the second big driver of why perps is the accessibility, obviously 27 trading. While in crypto, 24/7 trading isn't that like new. It becomes very interesting when you look at where perps are heading, and that is they're being rolled out, or at least there's the desire to roll them out across different asset classes. So we've already seen this year, obviously, pick up in trading volume in equities. Commodities is also a very interesting one. So there are multiple financial instruments that are looking at the innovation that perp future contracts brought to look to implement them. And 24/7 trading is very like easily implemented there because obviously you're not dealing with an underlying. So accessibility, I think, is the second one. And then lastly, slightly more technical, but this is around capital efficiency. So I personally strongly believe that the volatility of an asset price is becoming a product, and that's what retail also wants. That's why retail is like trading heavily into crypto and has been doing so this year in equity. It's because it wants volatility. And this volatility can be easily achieved at a very capital efficient way through the use of perpetual futures, right? Like 2x, 5x, 10 times leverage very easily through the use of perpetual contracts. So as a result, I think the amalgamation of these three are pushing, I think, mainstream adoption of perpetual futures. If we move on the right-hand side of this slide, it's clear that 2025 for perps have been the year. They've matured rapidly. At some point, we had monthly traded volumes on centralized and decentralized exchanges hitting north of 1 trillion, which is extremely impressive. And DEXs itself taking 26% share of that volume. Just for context, it's not added on this slide, but that's a significantly higher percentage than if you look at spots. Historically, spot DEXs capture a lower percentage of total volume, but perps seem to be like very well traded on decentralized exchanges. Obviously, UI, capital efficiency, all these things add up. DYDX being one of those exchanges, obviously. Even if you speak conservatively of like 1.2 trillion traded on a monthly basis, this is an immense amount, even in the context of total global markets. And I think that's a testament to where perpetual futures have come from. If you look at like 6-7 years ago until today, they've not only surpassed options, which at some point were a larger market within the crypto space, but I think they've validated themselves as like one of the most meaningful financial innovations that has come out of crypto in the past couple of years and is like set to meaningfully like impact traditional markets. If we look at like peak volumes, at some point we had open interest of 320 billion. Obviously, unfortunately, we've had 1010, but today we still have 150 billion of open interest, of which half sits within the long tail of assets, which, as mentioned earlier, is definitely growing. If we go to the second slide, so the question, the real like $1 million question is like, where do we go next? And I think the answer lies in perps expanding beyond this crypto native underlying into, as mentioned, equity perps. For example, in Q4 last year, we saw 1.7 billion in equity perp volumes being traded across over 400 different US stocks as an underlying across various platforms. And it raises, I think, an interesting question as well is, why are equity perps scaling faster than tokenized stocks? We've been talking about tokenized equities for years. I remember getting very excited about it in 2017. But the reality is, again, the simplicity. Tokenized stocks require custody solutions, settlement infrastructure, regulatory clarity. Equity perps sidestep all of this for the moment. You're not necessarily buying the underlying. Obviously, that's the current setup. But again, the simplicity just makes this a very scalable solution, I think, to roll out across different asset classes. Finally, quickly, as a liquidity provider, obviously, there's some things we're looking for in perp venues, and that is transparent risk engines, deep reliable liquidity, Oracle robustness, a form of capital efficiency. Obviously, that's what we find in DYDX as well. Quickly to wrap it up, before we jump into a quick Q&A, a perps one because of simplicity, accessibility, capital efficiency. I think they're now expanding beyond crypto into equities and commodities, and the on-chain infrastructure is increasingly what TradFi is converging towards. There feels no other way around it, to be honest.
Jasper, thanks a lot. When I look at those numbers you bring together on these two slides, it's just amazing to see. And you were mentioning this, how this on-chain crypto derivative market has been growing over the years. And it's sometimes we're busy in our everyday things, and when we take a step back with you, we just realize that the growth of this market is real. Many people have been convinced and built toward this vision, and this vision is actually happening before our eyes now. There is still a lot of work to do. There is still a lot of things to polish, but it's just amazing the amount of progress made and how this mostly CFI universe of perps has been expanding into DeFi now and how it makes sense. I would like to put you on the spot, but in a very friendly manner. Don't worry. I have a few questions for you, which we can go through in a rapid fire kind of things. Are you ready?
Yes, let's go for it.
So the first question on the next slide is, and you kind of touch on this during your presentation. It seems that the equity perps have been growing stronger and faster than the tokenized stocks. Can you come back to us again and maybe try to convince someone which is thinking of trading, let's say Tesla or anything like this? Why this market has been evolving maybe in a counterintuitive way?
I think it's very interesting. Obviously, it also piggybacked onto like tokenized stocks and giving that entire paradigm a purpose because first and foremost, we've been trying to tokenize equity for a while. Perps, I think, give it like that unique use case. That's first and foremost. But secondly, again, I think the accessibility, the 24/7 trading, obviously CME and New York Stock Exchange announced something similar. But that is very big. And then I think the elegance of like the leverage solution, I think is very appealing as volatility is the product for a lot of investments for retail, right?
So for 2026, do you think this trend will keep going and equity perps will dominate tokenized stocks?
I think they will grow in tandem, honestly. I feel like the perps give tokenizing equities also some kind of purpose because currently we have the solution where there's not necessarily an underlying underneath these perps, but as the regulatory framework changes, the possibility is very likely that the stock itself will need to be tokenized and sit within like registered on a specific DLT somewhere. So they're always asking for like the application. So far on tokenized equities, people have been pushing costs. I feel like perps is a very interesting, I think, angle to start leaning into that.
Talking about equity perps, I would like to kind of double click on the trading venues around this equity perps. And we've seen like three different major players starting to kind of touch this new and very innovative product. We've got the centralized exchanges servicing the retail the users for the most part, the DEX platform servicing crypto native traders, as well as institutional exchanges, like the more kind of legacy, very large players. So each of these trading venues have their own profile, sizing in terms of volumes and target and regulatory pathways. Which tier do you think will win in 2026 and maybe call it 27 as well, between the centralized exchanges targeting retail, the DEX and crypto native, and later on the institutional exchanges? Which venue will be the venue of choice for very large volume and healthy liquidity on the equity perps in 26?
I think, like, honestly, as someone who's more crypto native, I would lean heavily towards Dexus. But I think the reality is somewhere along the middle. I feel like and especially initially, they will very strongly coexist. Like, if you look at centralized exchanges, they capture that volume and they already have that retail distribution. Decentralized, it captures like the self-custody argument, the 24/7 crowd. And then institutional captures the mandated capital. So the ones that are more constrained around like the mandate around the capital they run. So the three of them coexist quite nicely. I could definitely see one leg taking off before the other, but ultimately I think the three of them will mature and again coexist, but they will also converge. I feel like as TradFi dabbles into DeFi with the use of blockchain technology, but also vice versa. I feel like a lot of like crypto native protocols will ultimately also lean into TradFi as there will be regulatory clarity and as the hurdle to like start pushing into these asset classes or the barrier of entry gets lowered year in, year out, right?
Thank you for that, Jasper. For the next question, I need your expertise. If we look at the institutional flow coming into crypto, they mostly favor Bitcoin, Ethereum ETF for the most part. And this has been doing great for our ecosystem overall. The question I have in my mind is, does this challenge or validate the crypto exchange models? since all the liquidity seems to be focusing on these two kind of premier assets, how will this essentially influence the business of exchanges, and how can we find a good and durable liquidity for the crypto asset class in general, not only like the majors, but also the altcoins?
I think that's a super interesting question, especially I feel like in 24 it was very difficult to assess the impact of ETFs and subsequently DATs, which in its own are a liquidity vehicle, which puts liquidity into the crypto markets. But I think 2025 made it very clear that structurally it is somewhat changing. There is liquidity which traditionally would have found another venue. But I think it's glass half full from my perspective, where I think a lot of liquidity is today funneled through the BTC ETF, which would otherwise never find its way into crypto either, anyway. And I think that is the very interesting opportunity for let's say the crypto native exchanges, right? Because ETF flow on its own, these require hedges, these require risk management. I think there's a whole slew of products that could potentially sit around these ETFs in serving them and supporting these ETFs. I don't think you should look at them as like competing products. I think it brings that additional liquidity, that additional capital into the space, which I think presents a very exciting opportunity if catered correctly to.
Thank you, Jasper. My last question. Thank you so much for your time. I would like to kind of double click on this narrative we heard during Q4 2025 about the kind of universal exchange, the exchange a la Coinbase or the exchange a la Robinhood, where you will find payment, crypto, stablecoin, equity, tokenized equity, TradFi rails, crypto rails. Do you think it's going to become a reality in a realistic timeline, or this is just some kind of aspirational buzzwords?
I feel like a lot of things in crypto are always 5 years out. So that's going to be my estimation. In 5 years from now, we'll have that universal exchange. But jokes aside, I think from a technological perspective, we are at that point where we can like seamlessly integrate DLT within centralized systems. So from a tech perspective, I think like theoretically it's possible. I think the big blocker still is blending all jurisdictions together, finding regulatory framework that fits all these different asset classes. There, for example, prediction markets, I feel like that framework is still moving. It's definitely possible. I definitely think it will become a reality in the medium to, let's say, like, yeah, the medium term future. The big one is, I think, whoever figures out the compliance layer will be like a key winner. So compliance and the regulatory question around that entire platform, I think, is the big one to crack.
The DeFi mullet, DeFi in the front, fintech at the back is not dead. So thank you for this prediction, Jasper. I appreciate that. Jasper, thank you so much for joining us this monthly analyst calls of DYDX. We really appreciate your time. Thank you for sharing the research you're doing at Wintermute. And thank you to Wintermute as well for being a partner of the DYDX protocol. Since almost day one, you've been very, very much OGs in our space. So we really appreciate your time today. Thanks again for joining us.
Thanks again for having me, Charles.
Absolutely. We'll keep going with the presentation of the annual call. We would like to kind of highlight some of the strategic initiatives happening in the ecosystem. First on the line is the partnership with FalconX, which will be essentially joining as a institutional liquidity provider and routing for expanding the DYDX market for professional trading firms, helping with liquidity on some parts of the order book, which have been a little bit requiring more attention, making sure there are deeper order books, tighter spreads, as well as improved execution quality across the supporting markets. So DYDX had over the past years different liquidity provisions program, and DYDX as an ecosystem is welcoming FalconX to support us with this part of the liquidity provision and facilitation overall the protocol. So looking forward to these partnerships and looking forward to speak to them as well soon during those calls.
So next we have some incentive programs. The first one is Surge Season 10. So Surge is a community-approved governance program that is designed to essentially reward traders and increase the adoption of DYDX. For season 10, we have a 50% fee rebate continuing through for UE and API traders. So for UE traders, I just mean the people who trade on DYDX.trade or the people who use the mobile app for trading, as well as the algorithmic traders, so the API traders. And then we have Sol and BTC perps. These will remain fee-free for January as well. This has been a program that's been live since November, and we've seen some good results from it, so it continues in January. And then we have a $1 million loss rebate pilot program that was launched in December. So that one's continuing as well through January. And finally, the 50% fee rebates will typically be distributed at the end of the month. So if you don't see your rewards, that's perfectly normal. They will come at the end of the month for the previous month. And then this slide just is aimed to show you where you can find your losses rebates. Most people are used to the rewards tab. So if you check, there's a second tab with rebates. And here you can see all the P&L for the people who have lost the money, the people who've made some money, and the estimated subsidy for the losses. And then, like I mentioned, BTC and Sol are fee-free. There's a fee holiday going into January. And then season 11, just so you know, will be coming in February. So stay tuned. There will be a governance proposal on the forums. And then this will then be shared on social media channels once that information is made available as to what the incentives are. If you participated in trading leagues in December, you have until January 31st to claim your rewards. And to do that, you're going to come back to this tab that I showed you, click on the rebates tab, and over here you'll see check eligibility. You want to click on here, and then you want to enter your DYDX wallet and your Telegram handle for payout confirmation. And then you just click on check and you will be good to go. We are at the end of the call, so a couple calls to action. The first one being, as Charles mentioned, we had the annual report go out a few days ago. So if you haven't read it and you'd be interested in giving it a look, head on over to ecosystem.report/DYDX. We have these analyst calls every month, towards the end of the month or around mid-month. So you can, proactively just subscribe to the DYDX Foundation Luma, and then you'll get all our, correspondence as far as the analyst call is concerned. But we also do sometimes co-host events, sometimes we host events. So that would be a good way to stay updated on everything that we're up to. Last but not least, we're on social media, we're on Discord, we're on Telegram. So follow us, have conversations with us, engage with us. The handles are at DYDX and at DYDX Foundation.
Winnie, thank you very much for helping preparing this call. Thank you, Jasper, as well for joining us this month in the call. Thank you, everyone, for joining us. I look forward to a solid 2026 together with the community of DYDX, all the builders and the users, and looking forward also to meet you at some of the events we will be attending. Before that, stay well, and may the trend be with you.
Have a good one, guys. Bye.